So recently, Bhavish Agarwal, the founder of Ola Electric Mobility, did something that really irked the capital markets regulator.
SEBI warns Ola Electric over social media disclosures before stock exchange updates.
भारतीय स्टॉक मार्केट रेगुलेटर सेबी ने ओला इलेक्ट्रिक मोबिलिटी लिमिटेड को एक्सचेंज से पहले सोशल मीडिया पर अपनी एक्सपेंशन प्लान का ऐलान करने को लेकर फटकार लगाई।
So what did Agarwal do? He put up a post on X, formerly Twitter, saying that the company's stores would expand from 800 to 4,000 in a month. Exactly 3.5 hours later, the company gave the same information to the stock exchanges. Now, in the interim, that's between the announcements on the social media and the exchanges, Ola's stock moved 9% and then closed 7% up on the Sensex. A month later, on January 7th, Sebi sent an administrative warning to the company saying that it has violated multiple listing and disclosure norms. According to reports, the regulator said that the violations included failing to provide timely information to stock exchanges, not ensuring equal access to information to all investors, and not considering stakeholder interest by prioritizing social media announcements over proper exchange disclosures. Now, there haven't been too many cases like this. I mean, making disclosures on other platforms before the exchanges. The only one in my ready reckoning is when on 26 September 2003, a top executive at Ispat Industries in an interview to a news channel had shared the company's projections of turnover, cost savings and export target resulting out of its planned capacity expansion. 6 months after that, Sebi had warned the executive to be quote-unquote more careful in future and ensure compliance with the regulator's disclosure norms. A more famous global instance is of course from August 7, 2018, when Elon Musk had tweeted the following: "Am considering taking Tesla private at $420, funding secured." That was a fateful tweet. Tesla of course never went private and its shareholders lost billions of dollars, leading the Securities and Exchange Commission to slap a penalty on Musk. More recently, on Tuesday, the SEC again sued Musk for allegedly failing to disclose the purchase of more than 5% of X's common stock in March 2022. So, from Bhavish Agarwal's incident, several questions arise. Why are disclosure norms so important? Are newly listed Indian companies lax about following them? The point of my sharing Agarwal's and Musk's instances side by side was that India's disclosure norms are largely modelled on the US SEC rules, but they are very different and much more rigid. How? And if so, should they be moderated to allow announcements on other platforms in keeping with the current times? We discuss all this and more in today's episode. It's Thursday, the 16th of January. I'm your host Anirban Chaudhary, and this is the Morning Brief.
Okay, so I think from a fundamental standpoint, one of the basic principles of securities surveillance or rather oversight has always been that equal access of price sensitive information to all investors.
That's Shishir Prasad, editor, ET Prime. Shishir and Praveen Palande, editor markets at ET Prime, recently wrote an analytical piece on the Ola fiasco. Here's Shishir.
And let's not forget, Ola and its founder are very high profile entities. So I think the profile has also got something to do with it. Maybe had it been a lesser known company, probably it would have gone unnoticed.
And here's Praveen.
So I think what we need to understand is social media is huge now. It is big and it has the power to move actually stock prices. Okay. I mean, like probably bigger than what information that can come from even the exchanges, because the quantum of people, okay, who are there on social media, the most of humankind is there on social media right now. And considering that, I mean, it really becomes a very sensitive topic when you kind of put information, sensitive information on Twitter.
Now, hold that thought on how influential social media is. For now, let's look at Sebi's reaction. So, is it the tweet that actually irked Sebi, or was it the stock price increase? Here are Shishir and Praveen again.
Yeah, I agree with you. I don't think the tweet had something which was very, very, I would say, price sensitive. It's just that it says we're going to open 4,000 more stores. That does not promise anything to any investor. I mean, in fact, it's exactly the opposite, because 4,000 store openings means they will have to spend more.
Right.
So, but I think investors probably read it in a different way. They saw it as a positive news, and the price moved 9%, and that's a lot.
I mean, see, firstly, you know, you need to understand that information should be secular in nature, that everyone should be getting the same information at the same time. And if you are creating a difference, like and maybe knowingly or even unknowingly, like if I give you some information about a stock and I give someone else, say after say 2 seconds, someone else after 3 seconds, you are creating a cycle, you are creating a chain of time lag out there, okay, and that is wrong.
So, I asked Shishir a broader question. Does this reflect a lack of or a limited awareness amongst new age Indian listed companies about disclosure rules? For instance, about, say, what is material information that can move stock prices and what's not.
You're absolutely, I think you're bang on target, because what has happened is that you've had a wave of companies who have participated in the IPO boom of the last couple of years, and not many of them really can differentiate between what is what is material information and what is not.
Absolutely.
And in fact, there is an analysis which Sebi itself did, and they published this a consultation paper last year in May, where they found that companies had published so many press releases which had material information, and they had failed to notify the exchanges. And this is a very large universe of companies that has been analyzed, almost 1,000 press releases. There are certain things which are very clear, right? If you say that I've got a direct order or something like that, my revenue is going to go up, things like that, which is very clearly price sensitive. A lot of other stuff is very difficult to make out. So, and the finer you go inside this, the more complicated it will get.
Right. And talking about where information should be disseminated first, whether social media or exchanges, and the SEBI is very terse and strict about that. Do you think it's time, given how, and you called Bhavesh influential, and he is, and he has millions of followers on Twitter, and a minuscule percentage of that would actually go to the exchanges and check, and they need to know all this. Do you think the SEBI should come some way in allowing maybe dissemination on other platforms as well?
Yeah, I think here, so obviously there is a role or a part that SEBI can play. And you're right, it's only old-time investors who will probably go to the exchange filings and things like that. Maybe there is a technology intervention that if I put out some information on X, it probably is also sends it out to the stock exchange.
Right.
So that it simultaneity of information publishing is assured. I don't think a lot of entrepreneurs really, I mean, there would be some bad apples, but I don't think most people want to be on the wrong side of a securities regulator and tweet stuff out that will get them into trouble. So yeah, SEBI can play its role. It can probably simplify the framework as well of what constitutes as unpublished but important information.
And that is a fundamental point. To understand this better, I spoke to Sandeep Parekh, a former board member at SEBI and now managing partner at FinSec Law Advisors. Now, like I said, The Indian disclosure norms are modeled on something called Regulation FD or Reg FD in the US. The law states that when a publicly traded company or issuer of stock discloses any material non public information regarding that issuer or its securities to a limited group of individuals, the issuer must also make public disclosure of that information. Such disclosures must be made simultaneously if it is an intentional release of information, or promptly if the information shared was non intentional. So, how are Indian laws different? Here's Sandeep.
Right. So the Indian rule is kind of very blanket, right? So it's basically says any material information which you want to share, we will not let you share it anywhere else. You can't talk to people, you can't go on Twitter, you can't come on live TV. The only website we recognize is the stock exchange website, and no other information can flow in it in any other direction really. So that's very, very unlike the original rule which we have sought to kind of copy. Essentially, I think when they implemented this rule, they had got more than 6,000 comments. And based on all the comments that they received, pretty much everybody supported the fact that you should not be disclosing select information to only your favorite analysts, and therefore, in a way, kind of violating your duty to kind of spread the information to the investors at large. Now, what they did was they narrowed it down in two or three manners. First is they narrowed down to who are the people who are restricted, number one. Number two, the definition of material non-public is not something which can be guessed, right? So your definition is different and mine is different. He can't go after you, right? Even a lawsuit cannot be filed based on differing interpretations of what is material or not. Third is, it's very important, and this is, I think, the biggest difference is it has to be either reckless or intentional, and even then it's not a violation, right? So if you intentionally kind of selectively disclose information to people, you are supposed to make a corrective disclosure. You're not kind of in violation of the rule. So it's a very, very kind of beneficial way of looking at things, that if you make a mistake, we'll let you make a mistake, but correct it immediately. Promptly is the word that they use for non-intentional disclosures. If it's intentional, then you have to do it quickly. So simultaneously is the word that they use. And the most important thing which we have kind of not done at all is they've said you can use any media. And we have said only stock exchange is the only forum that is acceptable. They in fact have said that we are not going to choose media. You can come on live TV. And again, it's an old case. In fact, if you remember, around 10 years back, somebody came on CNBC live, millions of people, but they got a rap. This part, that's right. They got a rap on the knuckles saying that why did you come on TV? You should have disclosed this information before on the exchange. So I think it's a huge departure to say that you can't speak anywhere else. There's only one forum, and I really doubt if Bhavish has 500,000 followers, whether the stock exchange disclosure is going to reach as many people as his own Twitter profile. So I think we've like I said, we've gone overboard. Number one, in terms of solving the problem, we have kind of created it, made it a violation if you don't do it. And number two, we said that you can only kind of walk in this straight line, and if you walk a little bit on the left, we're going to prosecute you. So I think there's a big difference between the two approaches.
Got it. But don't you think this will lead to cases like, that famous funding secured tweet of, Elon Musk when he said that he'd go private and then investors lost billions of dollars and he was just fined a paltry, I think, $40 million or something. Don't you think there are such pitfalls? And especially in India where, social media is kind of a quagmire of all sorts of fake stuff, etc.
Yeah, so I think see that's actually a different issue, right? One is you have actual information and you share it beforehand in, let's say, Twitter or CNBC or whatever, ET now. The other is where you give information which is not correct yet. In that case, Elon's essentially kind of saying things which are not even approved by the board yet, what he had said. So it's not a case of non-public disclosure. It's a case of no disclosure, because
Right.
you're
Right.
disclosing something which doesn't exist. So it's kind
Right.
of more in line with manipulation rather than insider trading or non-public information. So according to me, that's a different offense really that he committed, which is saying something which is actually not true. It was his kind of wish really.
But
That's
isn't
it.
there more accountability when you disclose it to the exchanges rather than when you disclose it on X?
So, I mean, you can argue that, but the look at the downside. The downside is far, far worse, which is you chilling all kinds of information and all kinds of people, right? So I can't talk to my wife about quarterly numbers. Both of us have become offenders, which is not the case. If you look at Reg FD, it talks of specific kinds of people who you talk to. They talk about analysts, they talk about specific kinds of investment advisors, etc. So it's not meant to chill information, innocent information, and they bring in the intention, right? So even if it's reckless, they're saying you're not committed a crime, so long
Got
as
it.
you kind of take immediate corrective action.
So, Sandeep does make a strong case about a tapering down of disclosure rules or disclosure rules being more inclusive. I asked him if he sees the regulator actually tweaking them. I mean, are there counter lessons for the regulator too from the Ola incident?
So Ola, I think they've just given a warning. So I wouldn't say that it's been over enthusiastic in enforcement, but like I said, there have been past cases where they have gone after people which seem very kosher to me, being on live on TV or kind of making a statement to a very broad audience. Even Bhavish, according to me, I don't think there's anything wrong with. Yeah, so I think we do need. I don't think there's much debate on this. I think maybe your podcast helps kindle a debate on how this chills information flow, and how we need to kind of craft it more narrowly as opposed to blanket prohibition.
On that food for thought, we wrap up our episode. You were listening to it on the Morning Brief. It was produced by Surohini Jain and me, sound designed by Amrit Reggie. Keep listening to the Morning Brief, which drops every Tuesday, Thursday, and Friday, wherever you get your podcasts. Have a good rest of the week. External clips used in this episode belong to their owners. Credits are mentioned in the description.